In 1971, a full year of college tuition at Harvard University cost $1,520. Adjusted for inflation, that is approximately $11,000 in today's money. Today, a single year at Harvard costs over $59,000. That is not inflation. That is a 500% increase above inflation. And Harvard is not the exception. It is the model that every university in America copied, scaled, and built an entire financial system around. But here's the question nobody in that system wants you to ask. If the price of education increased 500% above inflation, and wages for college graduates have barely kept pace with inflation, who exactly got rich? Stay with me, because the answer is going to change how you see every diploma on every wall. Before 1972, if you could not afford college, you either did not go, or you worked your way through. The market had a natural ceiling on tuition because students could only pay what they could earn or save. Then the government introduced guaranteed student loans. On the surface, it looked like generosity. Access to education for everyone regardless of background. A ladder built by policy for the people who needed it most. But here is what actually happened, and this is the part that the universities understood immediately and the students understood only decades later. When the government guarantees that every student can borrow unlimited money to attend any institution, the institution no longer needs to compete on price. The natural ceiling disappeared overnight, and tuition began rising at a rate that has outpaced inflation every single year for the past 50 years. The government did not make education affordable. It made education infinitely fundable, and the universities raised prices to absorb every dollar of available funding. You were not given access to education. You were given access to debt, and the education system was given access to you. Here is where it gets personal. Here is where the math stops being history and starts being your life. The average student loan balance for a 4-year degree graduate in America is approximately $37,000. For graduate and professional degrees, law, medicine, business, the average crosses $100,000. Some borrowers carry $200,000, $300,000, $400,000. But the balance is not the problem. The problem is the interest. A $37,000 loan at 6% interest on a standard 10-year repayment plan costs the borrower approximately $49,000 total. $12,000 in interest on a $37,000 loan. Now add income-based repayment plans, which extend the loan to 20 or 25 years. The same $37,000 loan on an extended plan can cost over $70,000 total. Nearly double the original amount. Paid over a quarter of a century. And while you are paying, the loan is accruing interest faster than most monthly payments can cover. A phenomenon called negative amortization, where your balance actually grows despite making payments, is affecting millions of borrowers right now. They did not just sell you an education. They sold you a product that charges you interest while you sleep, penalizes you for low income, and in many cases cannot be discharged even if you declare bankruptcy. That last point, remember it. We're coming back to it. In 1976, Congress made federal student loans non-dischargeable in bankruptcy. In 2005, that protection was extended to private student loans as well. Think about what that means. Every other form of consumer debt in America, credit cards, medical bills, car loans, personal loans, can be discharged in bankruptcy. You can walk away from them. The financial system has a reset button. Student loans do not have a reset button. You can lose your house in bankruptcy and keep moving. You can default on credit cards and eventually rebuild. But student loan debt follows you permanently. It can garnish your wages. It can seize your tax refund. In some states, it can suspend your professional license, the very license you borrowed the money to obtain. The system created a product that cannot be returned, cannot be escaped, and accrues interest regardless of whether the education it purchased ever produced the income it promised. And then it sold that product to 18-year-olds who were told it was an investment. Here is the cruelest part of this entire design. And this is where I need you to pay close attention because this next section explains why the trap has no visible exit. The credential inflation problem. As more people obtain degrees, employers raise degree requirements for positions that previously did not require them. A job that needed a high school diploma in 1980 now requires a bachelor's degree. A job that needed a bachelor's degree now requires a master's. The credential became required not because the job changed, but because the supply of credential holders made it a free filter. So, the people who cannot afford the credential fall further behind. The people who borrow to obtain it spend years repaying debt before accumulating any wealth. And the employers who now require the credential contributed nothing to the system that produced it. The credential lost value precisely because everyone was pressured to get it, and the debt required to get it stayed the same. You were told a degree was a ticket to the middle class. For many people, it became the ticket to starting the middle class $30,000 behind where their parents started, with monthly payments that consume the wealth-building years before any wealth can be built. The people who navigate this trap successfully almost always do one of three things. They choose fields where the credential produces income that genuinely services the debt: engineering, medicine, certain technology roles. The math works. The debt is real, but the return justifies it. They aggressively pursue income-driven repayment forgiveness programs, understanding that on certain plans, balances are forgiven after 20 or 25 years of payments and structuring their finances accordingly. Or they never borrow in the first place. Community college, trade programs, certifications, self-education, apprenticeships. The paths that produce income without producing six-figure debt. The paths the guidance counselors never mentioned because universities do not pay guidance counselors. The most dangerous financial decision most people ever make happens at 18 years old with no financial education, under enormous social pressure, for a product whose price was artificially inflated by the very government guaranteeing the loans used to purchase it. The student loan system was not built to educate you. It was built to extract from you your future income, your wealth-building years, your financial flexibility, in exchange for a credential whose value was deliberately inflated by the same institutions charging you for it. This is not a criticism of education. Knowledge is one of the most powerful tools available to any human being. This is a criticism of a financing system that weaponized the desire for knowledge and turned it into the most inescapable debt product ever created. Drop a yes in the comments if you are still paying for a degree that never delivered what it promised. Because you are not alone. You are one of 43 million Americans carrying a total of $1.7 trillion in student loan debt. $1.7 trillion. Let that number sit for a moment. Subscribe right now because next week I will show you exactly how to evaluate whether a degree is worth borrowing for and the alternative paths that are quietly producing better financial outcomes than four-year universities for millions of people. They sold you the dream. They kept the deed.